Welcome to another episode of Map Your Money. I'm one of your co-hosts, Arish and wealth advisor and certified financial planner. I'm joined with my other co-host, Jeff Cohn, chartered financial analyst and chief investment officer, as well as our special guest today, Meg Randall, our chief operating officer. It's been a while since we've had you on the podcast, Meg. Welcome back.
Thank you. Thank you. Happy to be here.
Yes, welcome back, Meg. Great to have you.
Love it. Well, we have an awesome episode for y'all today talking about something that I think is extremely important. And I know we kind of get down and dirty about the markets, the economy, how we're investing, and all of these different things, which are obviously extremely important. But sometimes we forget to talk about the importance of client behavior and investor behavior and just the way that people think about money. And I think it's so important and something that's often overlooked. So want to give it its own merit and give it its whole episode. So we'll get into some different biases and talk about the psychology of money. But like always, before that, like to start with something light, a nice little icebreaker. And today I'm going to ask Jeff and Meg if they have any TV or movie recs. I know we've talked about this in the past, but see if you guys have anything new. I have some if y'all don't have any.
Oh, Jeff, you might have to go first.
Okay, well, I have one right off the top of my head. It's a little show called House of Dragon, which is the prequel for Game of Thrones. Couldn't stay up late for it on Sunday, so ended up having to watch the latest episode 4 last night. And let me tell you, it is getting spicy in that show. If you have not checked it out, please do.
Oh, yeah.
It is rated M for mature audiences, so please keep that in mind. But a great show all around. A lot of action, a lot of suspense, a lot of drama. Really good show.
Great disclosure with the M for mature, but I watched that last episode as well. And it's definitely heating up. I'm a huge fan of Game of Thrones originally, so love the spinoff. Are you into the Game of Thrones world, Meg?
I did watch all of Game of Thrones. I actually forgot until you guys started talking about it that House of Dragon was a show. I think I watched the last season. What season are they in right now?
2.
Yeah,
Season 2.
I think I watched the last season, but I didn't even know it was back. Shows how culturally aware I am. So I have to check that out. Thanks for the rec.
Yeah, well, when you put the little boy down, make sure to put on the House of Dragon. You got to get caught up. It's getting good.
It's like you said, spicy.
For sure.
This might be a little late to the game, but Shogun, if you guys didn't watch it, was 10 out of 10. Also, I think rated M for mature, but 10 out of 10.
Is that a movie or a TV show?
TV show.
But it's got the subtitles, right? Kind of like
Narcos. It's got subtitles. Yeah,
Okay.
If you're into samurai and samurai and subtitles, that's what I'll call it.
Nice.
I'm hooked already. I'll have to check it out. But like I mentioned, we have an awesome episode, so let's get into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and help individuals create the roadmap for their financial future. Content is for educational purposes only. Consult a financial advisor or conduct your own due diligence of investing. Calls are pre-screened and the content was pre-recorded.
All right, so we figured the best way to start off this episode would be starting with a statistic. So I'm going to kick it to you, Meg, for this stat.
Yeah. So as we talk about different biases and psychology and why we do what we do, I think this is a really compelling statistic because it really impacted me or resonated with me when I saw it. So let's talk about the benefits of working with a financial advisor. Vanguard study done in 2021 showed that investors who work with financial advisors have been found to achieve on average 3% higher returns than those who don't seek professional advice. And I think this is just a great way to tee up today's conversation because I think a lot of that 3% is just advisors are able to partner with clients to help them avoid some of those biases.
Yeah, no, that's a great stat, Meg. And I think it's really, really important. Obviously, the investment management and how you allocate your assets in your portfolio are extremely important and have a huge impact on how your portfolio does. But I think one of the biggest value adds of working with an advisor is them protecting you from yourself. There's so many different biases and different ways that you can think about money and irrational ways that everyone thinks about money and different things. And so it's important to be able to work with someone to kind of check some of your beliefs at the door, have a bouncing wall to where when this or that happens in the news, or you have this thought because of some idea, you're not quick to make some irrational decision or some major impact on your portfolio that might have a huge impact down the line. And I think working with an advisor, personally, I've seen a huge impact being able to work with clients and really bounce ideas off of them and say, okay, they have this thought or that thought, which may be a fallacy, and want to talk about some of those so people have a better idea of what is a bias and what's important there. But Jeff, you kind of have some more information around different types of bias, and then we can kind of get down and dirty and talk about specific ones as well.
Yeah, sure. So let's kind of start with what we mean by a behavioral bias. So there's a whole branch of economics called behavioral economics that really looks to observe and study actual human behavior. And the reason why that's important is because in traditional economic and finance theory, there is this assumption that individuals act rationally, that they consider all the information available to them, and then they optimize for the best outcome for them. So think about this in context of an investment portfolio. We're trying to optimize the amount of return that we can get per unit of risk, or optimize the amount of risk to get for a given return target, right? And what we're going to do is we're going to take all the different assets out there, all the different information about those assets, historical return and risk, right? The covariance, all of that, put that together and try to optimize for that portfolio allocation. That's essentially what economists and theorists assume people behave. But what we notice is that people actually violate those assumptions all the time. They don't actually optimize for their outcomes. Maybe that's because they're not taking in information as well as they should, right? They're not incorporating new information correctly. Maybe that's because the optimization process just takes too long, right? There's so much data out there. There's so much information that how can we possibly go through all of that and optimize for one single solution, right? Some behavioral economists use the term satisfice, right? So consumers are not necessarily optimizing for what they want, but they're finding something that is good enough, right? And that's kind of like a way that consumers take shortcuts, and could be a behavioral bias. And so that's really what we're talking about here is, when are some of these economic assumptions of rationality violated in a recurring systematic way that's repeatable? And economists have actually been able to find this in a lot of different studies. And really they bracket out these behavioral biases into two different categories, right? So you have your cognitive biases. These are the biases that affect the way that you're incorporating new information. And then you have your emotional biases, which really are biases that are triggered by your impulse and your emotions. And we can go through examples of each of those.
You know what I thought might be fun to do today, y'all? I could tee up a few different client scenarios that we have seen before, and have y'all guess what the bias is and talk a little bit about it. What do you think? You ready?
Bring it. Let's go.
Oh, yeah.
All right. We'll call her Sarah. So client Sarah, she's been holding on to a stock that consistently underperformed for years. She refuses to sell it because she doesn't want to realize a loss and feels the stock will eventually recover. Her portfolio is suffering as a result. What bias do y'all think this is?
You got it, Arish. What do you think?
It's got to be loss aversion.
I think it's loss aversion.
I think it's got to be loss aversion.
I think so.
All right, you guys are 1 for 1 so far. So tell us more about loss aversion.
Yeah, so loss aversion is this phenomenon, right, where clients hate losses more than they love gains. That's kind of a way I think about it, right? So think of like the pain that a loss inflicts is a lot greater than the pleasure that a gain provides, right? And that's really important for clients because, like you mentioned, a client might not want to take a loss on a stock, and so then they're going to hold on to that stock a lot longer. On the other side, a client may sell winners a little too early, right? And typically what that means is that their overall portfolio returns are lower than what they otherwise should be. I will say that from an investment management standpoint, it's really important for us to understand some of these biases that all clients have and that we ourselves have, and manage portfolios in a way that put clients in an advantageous position to make the right decisions. And so one way that we think about loss aversion is knowing that when markets fall, clients really pay attention. They really don't like when they lose money, but when markets are doing okay, clients are generally satisfied with an okay to moderate to, a return that's positive and keeping up. And so what does that mean as managers? That means that we really need to emphasize downside mitigation and mitigating those losses whenever the market is starting to get volatile. And so, that's why we really talk about diversification a lot, why we talk about fixed income and the need for non-correlated and negative correlated assets to equities, because we know if that loss happens, clients are going to react in a way that's disproportional compared to how they would react if they had gains on the other side.
Exactly. And I think that pain of the loss being more than the pleasure of the gain is the most important aspect there. And clients, or silly Sarah in this example, or Sally?
Sarah. I like
Sarah?
silly Sarah.
Silly Sarah. Yeah, that's great.
Silly Sarah wanting to hold on to this position, even though it might not be something she has a ton of conviction in anymore, but she just doesn't want to realize this gain. And when you think about a brokerage account, a taxable account, you're actually able to take advantage of certain losses. And so I know a lot of people will use the example of, let's say she bought $1,000 of XYZ stock and now it's down to 750. And you went to silly Sarah today and said, if you had 750, would you buy XYZ? And if she were to say no, then it probably doesn't make sense to hold on to. And one of the additional reasons for that is because she's able to sell that in a brokerage account, take advantage of the gain. I know we're getting away from biases here, but my advisor brain's just churning. But you're able to take advantage of a gain there, take that money and reinvest it elsewhere into something you have conviction in. And so I think that's a bias we see all the time, because people, they don't want to pick a loser. They don't want to tell their friends, hey, I lost this much money on this stock. And once you sell it, you feel like, okay, that gain is locked in, or that loss is locked in. And so I think loss aversion is something that really holds a lot of investors back on the downside, holding on to positions they probably shouldn't hold on to for as long as they do.
Yeah, I think that's really insightful from both of you. And while it's fun to refer to this example as silly Sarah, I think it's also important to note, we're all human too. We're subject to biases as well. And
sure.
This is why I personally work with a financial advisor. We live and breathe this every day, but I need someone to hold me accountable and make sure I'm not being silly Sarah. So I think that's just an important point to note. Okay, 1 for 1. Y'all ready for your second?
Well, let's go.
All right.
Repeat.
Okay. All right. So we've got John. So John has received a significant inheritance from his late grandmother. He divides the money into different mental categories. So one portion of that money he considers safe and wants to preserve for emergencies, future expenses. Another portion he's viewing as play money for higher risk investments or discretionary spending. So what bias is this?
Yeah, so this is what's called as mental accounting. And it's something that, I guess before I jump in, am I right?
Yeah, 2 for 2.
Agree.
Well, Jeff
Okay,
didn't
okay.
guess, so who knows?
There you go. But yeah, mental accounting is something that we deal with all the time. And it's this fallacy to think of money in different ways. So you have an inheritance, or you have money from your job, or money from a side hustle. And each of this income in your head, or each of these piles of money in your head, represents a different type of way to spend, or a different type of goal for you. And say, okay, this is money I inherited from my dad or my grandpa or whoever it might be. I want to be super safe with this money. That was their money. Now it's here. Oh, this is my income. I earn this. I feel a little bit more comfortable taking a little bit more risk with this money. And the reason it's a fallacy is because at the end of the day, all of this money is your money. It's your money meant to serve the purpose of whatever your goals are in your life. And so using money from different sources and treating them with different risk classes is a big fallacy there. Because you're treating the location of where it's from in terms of how you're allocating it rather than the purpose of the money. I think it can be confused with saying, okay, I have different pools of money. One is more aggressive, one is more conservative. That is not mental accounting, because that is with the purpose of the different goals. Maybe I need this shorter term money to buy a house in the next few years, but I need this longer term money for retirement in 10 years or 15 years, and I can be a little bit more aggressive with it. And so it's something that we've dealt with a ton with many different clients, but it's certainly really, really important.
Yeah. And, I've seen it before where clients will kind of divide, money that they want to grow and like be risky, and then money that they want to maybe provide income. And the reason why this is maybe not the best way to do it is because those are assets with very different return profiles, risk and return profiles. And when you combine them together, you're not really sure what kind of portfolio that you're going to get. And the issue with separating out and kind of specifically targeting something for like income is that, that income is only one part of the total return story. You have the income that's being derived from the asset, but you actually have the price of the asset too. And so some people that kind of fall into this mental accounting stance will sometimes bucket out their assets in like income or growth or risk, and not realizing that, specifically targeting something like income can actually open them up to loss in other ways of the portfolio, say by, you bought that high yield bond that's offering you 9 to 10%, but it just declared bankruptcy. So now the price is down 50%, right? And so that's how some people can get burned on that too.
Yeah, definitely.
I feel like the term play money is something I hear so often. I've heard it in client meetings. I've heard my parents use it. I've heard friends use it. I feel like a lot of people like to have that bucket that they just think of as play money and do that mental accounting.
For sure.
Exactly. And at the end of the day, right, what we want to do is find the best risk and reward combination that's suitable for our clients' long-term goals, right? And we really want to do that on a consolidated basis. And we want to do that too based on, non-qualified accounts and IRA and Roth, by putting assets in the appropriate buckets that's going to give the client the best after-tax outcome for the risk that they're taking. And I think you can kind of lose sight of that ultimate objective whenever you start having separate buckets for all your money, just depending on, how you accrued that money.
I think those are excellent points. Okay, y'all want to do one more? We'll see if you can go 3 for 3.
Only one? Okay. Yeah, the 3P, Kobe Shaq. Let's go.
We didn't come up with a nickname, though, for John. We've got Silly Sarah. I could not come up with something that started with a J for John.
Jivin' John.
Jivin' John. Okay. All right. So
well done.
we'll go with the classic Jane in this scenario. So Jane is a successful entrepreneur. She believes her business acumen translates into stock market expertise, and frequently trades stocks based on her gut feelings and past successes without considering market research or expert advice. What one is this?
Well, it sounds like Jolly Jane there is suffering from some overconfidence bias. It sounds like she's taking in information that she's overestimating her own abilities. Maybe that's because of something unrelated that she does have skills in, and she's now applying that to something completely unrelated and not letting other people try to help, or not, searching for information outside of that. And that's what we would call overconfidence bias. And it's when people have, way too much confidence that they actually go out and make, errors in judgment without even realizing it. This can be because they try to be, too specific with what they're projecting, or it also can happen with the way they ascribe success to their personal traits, but then assign blame for failures to exogenous events, right? So it almost kind of like creates this cycle of overconfidence to where they see, okay, I have overconfidence, I'm going to go do this on my own. That worked out. Oh, that was because of me. Oh, and then whoops, this other stock I bought, it didn't work out. Oh yeah, but that's because, the CFO committed fraud, or oh, this weather event took out all the crops, or, that was unrelated to my expertise, right? And it kind of creates this vicious cycle of kind of, encouraging that overconfidence bias. Is that right, Meg?
3 for 3. Wow. Y'all are amazing at guessing biases.
But yeah, no, I definitely think overconfidence bias is something that's extremely important. And has a huge effect on how people invest their money. I think we're in a really interesting world these days with the amount of information that we have access to. And there's so much information from so many different sources. If you watch one TikTok or one video or one news clip, you can easily be convinced that this thing is perfectly set up in the way that it's the perfect investment, or it's an investment you want to stay very far away from. And it has a very easy tendency to be able to convince you of that 100%. And you will take that information in, you'll ignore all other information, and then really using basically the success of that or the failure of that to predicate on how that investment did. And another thing I would switch it over to is another bias that we see is confirmation bias. I think they kind of go hand in hand, because you can have this overconfidence and purchase something and have this original thought that, okay, because of XYZ, we're going to see this in this stock. And then you might see that appreciation in that stock, and it might be due to something completely unrelated. But you now have this confirmation bias that, okay, it went up and I had this investment thesis. Okay, it's because I was right, which is kind of the two of those put together. But
to add to that, Arish, the confirmation bias is a type of cognitive dissonance, right? And cognitive dissonance is discomfort whenever you receive new information that contradicts your initially held beliefs, right? So you learn something that you kind of on the opposite side of the fence on, and then you learn, maybe I'm wrong, right? And that's discomforting. A lot of us don't like that, right? We tend to reject that. Confirmation bias takes that a step further. It means that people are seeking out information that confirms what they already believe and ignoring or avoiding information that contradicts what they believe, right? So it creates this other vicious cycle, right? Where people are, like say right now, the economy, there's a lot of data out there that you can point to that says the economy's slowing, the economy's in a recession. And there's also a lot of data that shows that, the economy is just fine and we're not in a recession at all. People with some confirmation bias that maybe already believe the economy is in a recession may go seek out that information and say, oh, well, continuing jobless claims are rising, or delinquencies on credit card debt are rising. But if you have maybe a more unbiased stance, you might zoom out and say, well, credit card delinquencies were low during COVID and now are returning to, their 10-year average, right? And maybe there's not the total context provided there.
Certainly. And I think you can kind of use that. I know you mentioned the economy, but I know with election year coming up, this is something that's really relevant. And I know for a fact, regardless of who wins or who's in office, it's going to be something that you see. It's like, okay, the market or the economy is up or down, and it's because of this person being in office. And that's the reason why. And I think that to an extent is confirmation bias and something that's important to be aware of as well.
Yeah, it can be. I mean, I think, biases are very prevalent, especially when it comes to people and their impassioned opinions that they have, around politics. And, confirmation bias, certainly plays in there. I think of also, this is a bit of, recency bias and representative bias. They sometimes call it. And it's a specific niche of that's called sample size bias, to where maybe you take a small sample of something and then think it's representative of the overall population. And that's something I've noticed lately with inflation, where people will go and they'll go to McDonald's and be like, oh, look, the Big Mac is up 300% over the last 5 years. Wow, inflation is going nuts. And it's like, well, if you look at inflation of food items in the last 5 years, it's not up 300, 400%. It's up more like 20, 30%, right? Still uncomfortable, but nowhere near 300, 400. But they see all the fast food menu prices and they think, oh, let's extrapolate this out. Right. And as the political process starts, I think it's really important for us to kind of note those biases, because, if your preferred candidate gets elected, then you probably are going to want to go seek out that information that shows the economy's good and that inflation's falling. Right. And we've seen that, looking at consumer sentiment data for Republicans versus Democrats, they swing pretty wildly after, these elections. Right. Showing that people's real sentiment and themselves is really related to who's in the White House, right? Which is a bias in of itself.
Yeah, y'all have talked about some interesting biases. And I think, I don't have another quiz for you, but I think another one that's just important to bring up, it's really relevant to me when I watch the news, is hindsight bias. So tell us a little bit about that bias.
Yeah, certainly. And so I think hindsight bias is extremely important when you kind of think about after some sort of event happens, all of these different experts come up and they say, oh, okay, we just had this market correction and it's due to this, that, or the other. We should have known about it, and there's this many expectations of it. However, before that event happens, they don't really come up and say, okay, here are all the reasons why we're expecting this market crash or a market pullback, for example. And I think it's something that, okay, after it happens, you say, oh, here were all the warning signs. We should have known this was coming. In really saying, okay, hindsight's always 20/20 with the hindsight bias, but it's really important to recognize that you need to be aware that these things are always going to occur, and there's always going to be corrections and different things that happen in the market, and be in a position to where you're able to weather the storm and not really just look back and say, okay, this or that happened, I should have seen the warning signs. And I'll switch it over to you, Jeff, on that. But
yeah, I mean, I think that's all really great, and that's really what makes it tough is, after some events happened, it's easy to go back and like see the details of what caused it, and those details aren't necessarily available at the time in order to actually make that prediction. And so what's interesting about hindsight bias is people will not only think that they could have predicted something that happened, but they will also have gaps in their memories about their past predictions, and then overlay those memories with something where they actually predicted it right. And that there was actually this experiment done in 1975 where this guy Fishoff actually asked his subjects general knowledge questions from the encyclopedia and the almanac, and they all, write down their questions. They submit their answers to the professor, and then he gives them the correct answers to those questions and asks them, how many of you got it right? And they all overestimated how many questions they got right? Because they don't remember what they put, but they're filling in the gaps with what they already know, thinking, oh yeah, obviously I knew that because it's right in front of them, right? And I think with investments, this can really blow up whenever you see, companies that did really well, like let's say NVIDIA, and it's like, oh, well, obviously the AI boom was going to happen, and obviously we need NVIDIA chips to happen. Well, you weren't really hearing that a lot in 2022 when NVIDIA stock dropped 60%, right? But yet I think a lot of those people, maybe they don't remember how they felt about NVIDIA at that time, so maybe they're kind of creating their own memories where they're saying, I liked NVIDIA then, I just, didn't have enough money to put in it or something, and those are things that can cause clients to take more risk into the future, right? It kind of goes back to that overconfidence bias of, hey, I should have got this right. I should have seen this, and I can do it next time, so I'm going to try.
And I think that leads to the erroneous fallacy of market timing. And it's not necessarily a bias, but it's something that people see hindsight bias and they say, oh, this, that, or the other happened, and it caused that pullback in 2022 that we saw. Okay, we're seeing very similar indicators right now. I need to sell out of all of my investments now and rebuy later. And market timing is a huge fallacy, which is getting out of the market at irrational points of time or just trying to predict when the next pullback is going to happen. And we could probably do a whole episode on market timing and why it's not a successful way to invest. But you want to keep your assets invested for the long run and be able to weather the storm through the ups and downs. And that proves to be a much more effective strategy than trying to sell, buy back in at the bottom, because a lot of times you miss the rally. And there's a ton of statistics on how that works and how much return you lose in those scenarios. But it's led with things like hindsight bias, people going through the global financial crisis, having a huge hit on their portfolio. And then every time there's any worrisome indicator going forward, they want to sell all of it again because they don't want to go through that again. And so all reasons why it's important to work with someone to kind of check your own beliefs at the door, because there's so many different things that are involved with making decisions, especially around your money. Why I think it's so important to make sure that you're not making decisions based off of some potential fallacy or some bias, which is really affecting your returns long term.
I hear it's about time in the market, not timing the market.
Yeah, exactly. And another thing people say is, and obviously buying and selling, trying to time the market is a very emotional decision. After this conversation of all the biases we have, hopefully, clients realize that. But something else we say is, it's tough enough to get an investment decision right once. It's really tough to get it right twice. And that's what you have to do if you're timing the market. You have to know when to get out. You have to know when to get back in. And there's a lot of clients and a lot of people that I know and talked to in 2021 and 2022 that have been sitting on money market funds for quite a while, waiting for the right time to buy, and they got scared and they sold out, and then they couldn't pull the trigger to get back in. And, that's also something that we see with market timing.
All great points.
Definitely. Well, Meg and Jeff, I appreciate you guys being on the podcast, talking about some of these behavioral biases. I know there's a ton of them. So if you're interested in learning more about different biases, please reach out. We're more than happy to jump into different biases. And it's something that's really important to be aware of as you're making decisions, as you're thinking about your own finances. But thanks for joining the podcast. I'll be making sure to follow House of the Dragon and look at Shogun as well.
Definitely tune up the House of Dragon.
Samurais and subtitles.
Oh, yeah. Thanks.
All information provided by this presentation is for educational purposes only and does not constitute investment, legal, or tax advice. It is not an offer to buy or sell any security or any insurance product. This is not an endorsement of any third party or such third party's views. The information contained herein has been obtained from sources we believe to be reliable and is not guaranteed as to its accuracy or completeness. Whenever there are references to third-party content, this information is intended to provide additional perspective and should not be construed as an endorsement of any services, products, guidance, individuals, or points of view outside of Beam Wealth Advisors, DBA Benedetti Gooser and Associates. All examples are hypothetical and for illustrative purposes only. Beam Wealth Advisors, DBA Benedetti Gooser and Associates does not offer tax or legal advice. Interested parties are strongly encouraged to seek advice from qualified tax and/or legal experts regarding the best options for your particular circumstances.